week. Joining me now, we've got Adam Coons, Winthrop Capital Chief Investment Officer. Adam, good to have you here. And we mentioned tariff optimism. Perhaps it's a little bit more relief that it's not as wide-ranging as originally expected at the outlay. So how is your investment strategy changing as you navigate some of that recent volatility?
Well, this feels a lot like last year when there was all that focus on the Fed and what they were going to do, and markets were up and down and big waves on, kind of the crystal ball method of investing. And so for us, we came into this year definitely cautious, not because of tariffs, but just because of the increasing number of, uncertainties that we knew were going to hit the market. So that's one thing that Wall Street hates more than anything. They hate it more than bad news. That's uncertainty, because they just don't know how to position. So you see risk premium going up. That's why you've seen this decline, because there hasn't been a real fundamental change, right? This year, we haven't seen a big drop in earnings or anything like that that would drive stocks down as much as they are, particularly in the tech space. So when we came this year, we were more defensive, and so that has given us a little bit of dry powder right now. And so for us, this means that we have the ability to add. And so that's what we're doing, where we're underweight some of these different names that have really been beaten up. We're incrementally adding because we know we're not going to time it. So we're just trying to pick our spots.
And so where are you allocating capital right now then?
Yeah, so like I said, coming into this year, we were overweight to healthcare. We were overweight to lower beta, high dividend stocks. And so we're starting to shift away from that. And last week, we were adding to NVIDIA on weakness. And so, like I said, we were underweight NVIDIA coming into the year. That's worked for us in this small time frame. And so, like I said, that gives us the ability to add. So definitely in kind of the higher quality tech names where, like I said, the fundamentals haven't changed. This is more just kind of that narrative-based decline in the market. So that's where we're putting our money right now.
What is the best kind of rule of thumb that investors out there should be using to identify what a valid versus an invalid dip buying opportunity might look like?
Well, look, I think like I said, timing the market is extremely difficult. I mean, we don't recommend it. I think what you want to look at is, okay, what is my risk tolerance? Where am I underexposed? Where am I under allocated? Maybe where I've missed out previously, and starting to add there. But you don't want to go all in. You really want to start to kind of piece your way in. You may miss it on the upside, and that's okay. But there may be more downside. So like I said, the crystal ball method of investing rarely works. So I think really just having your buy list, knowing those companies that are fundamentally haven't changed. Now, if something's changed fundamentally, that's a different story. But in this case, where the fundamentals haven't changed, like I said, earnings, revenue, those things haven't shifted away from your thesis, you should be adding here when you're seeing the dip, because no matter what, even if you don't time it perfectly, the reality is we will come out of this, we will recover, and you'll be happy that you added to those names that you really believed in.
I was taking a look at a note that hit my inbox this morning from BlackRock talking about bright spots in global stocks here, and we've continued to hear at the start of this year about the U.S. exceptionalism trade, and then some of the mindset, especially as tariffs started to emerge and the tit for tat that surrounds that, it started to be more of a global stocks picture. So I wonder how you're kind of threading the needle in your own allocations as well and your own positioning.
Yeah, I mean, look, the U.S. markets have been the place to be for several years, and this is the first year we've seen a dramatic change in that. So I think you have to start to ask all of those questions. Is this a short-term reversal, or is this something that's going to last more long-term? And so we do divide the markets up. I think when you look at Europe and Japan, and when you're looking at those large developed countries that have outperformed, I just have to argue nothing. Once again, look at the fundamentals. What has structurally changed? And right now, there really isn't enough that structurally changed for me to say that this outperformance is justified. Now, when you look at China, and I think some of the shifts you're seeing there, that's where we're allocating more of our global allocation dollars, because that is a viable competitor to the U.S. here in the next 5 to 10 years, and so you're going to see more volatility out of a market like that. But we do see that as when you're looking at the global landscape, where are the opportunities for us? It's very bifurcated, and we see it really landing with the U.S. still and China long term. So those are where we're overweight, and then absolutely underweight when you're looking at Europe and Japan.
Adam, thanks so much for taking the time here with us today. Really appreciate the breakdown.
Thank you.